During the Civil War, the Union placed a blockade on Confederate ports. In 1864, David Farragut was tasked with closing the port of Mobile, Alabama, which had defied the order. When Admiral Farragut ordered his fleet to proceed, one of his ships hit a mine and sank, causing the rest of the fleet to hesitate. Farragut, however, was undeterred and famously exclaimed, "Damn the torpedoes! 4 bells! Captain Drayton, go ahead! Joyette, full speed!" Today's market has a similar ring to it. Investors are confidently navigating a minefield of uncertainties as the Fed hopes to steer the economy towards a soft economic landing. As the table illustrates, U.S. stocks have had a solid start to the new year. According to the Dow Jones Newswire, during the quarter, the S&P hit 22 new highs, the Dow 17 and the Nasdaq 4. Repeated new highs on major market indices suggests the rally, which was concentrated in a few large cap stocks last year, is actually broadening. A headline in the April 1st Wall Street Journal read, "Stock market's Magnificent Seven is now the Fab Four," going on to say it's a bullish signal that the market is rallying without the likes of Apple and Tesla, according to some investors. Dubbed the Magnificent Seven by Bank of America analysts last year, Apple, Microsoft, Nvidia, Tesla, Amazon, Meta, Facebook, as well as Alphabet were responsible for a big chunk of last year's advance in the S&P. It seems surprising the market could mount a rally without Apple's leadership, but that's precisely what happened last quarter. According to the Wall Street Journal, shares of Apple and Tesla slipped in Q1, and Alphabet only registered modest advances. So what's driving stocks higher? The rate of inflation is off its peak. The Federal Reserve is considering up to 3/4-point cuts this year, and moreover, the economy is expanding and corporate profit growth has been strong, according to LSEG, formerly Refinitiv. Finally, the AI locomotive has yet to show any signs of slowing down. We are always mindful that pullbacks are simply an unexpected headline away. Bull markets can create wealth for long-term investors who adhere to a diversified and disciplined approach, but market corrections can't be discounted. They are inevitable. What might create volatility? Well, unexpected bad economic news could jar the market, as that would cloud the outlook for corporate profits. Fed officials believe the recent uptick in inflation is only temporary. However, if recent sticky inflation numbers prove to be, well, a little stickier than expected, the Fed could delay projected rate cuts. Additionally, international tensions could spill over into the marketplace. When stocks tumble, it can be tempting to move away from equities and embrace cash. In the long term, however, that's rarely profitable. Once shy investors find themselves chasing the market higher. Conversely, a strong bull market can give one the aura of invincibility. Some might even say, now's the time to step on the gas and load up on stocks. A seemingly invincible market can encourage too much risk-taking, which can be compounded when your golfing buddy consistently reminds you of his newfound windfall and trading prowess. Yet, we caution against a more aggressive stance simply based on market actions. Financial plans aren't set in stone. There are many valid reasons an adjustment can and should be made, but market action is rarely a good reason to shift one's stance. I hope you found this review to be informative. If you have any questions or wish to discuss these matters, please don't hesitate to give me a call. Thanks so much.